Welcome, everybody. I'm Erich Patten.
And I'm Brook Anderson.
And we're here to have a conversation today about the OBBBA, the One Big Beautiful Bill Act, and how it might impact you from a financial planning perspective. There is a lot in this bill, Brook.
There is, for sure.
So we're going to talk about some of the most pertinent issues that we think will affect our clients, and we're going to do it using case studies. We've got another case study here. Our friend Martin. Martin is 74 years old. He's receiving Social Security. He lives in Issaquah, Washington, just down the road from where Brook and I are sitting today.
Yep.
And Martin has $3.7 million liquid net worth. He also has a home that's worth almost $2 million, about $1.95 million. And this is roughly a total estate of $5.7 million. Martin is on Medicare. And he wants to know, will I be taxed on my Social Security? But his situation really raises several questions from an OBBBA perspective. First is estate planning. And then secondly, we'll talk a little bit about retirement planning in terms of Social Security deductions and whatnot. So Brook, can you talk about what happened with the estate planning limitations within OBBBA, and how does that impact Cutler clients?
Yeah, yes. As some of you might realize, there was a large increase in the exemption from a federal estate tax perspective, and that limit was dramatically increased with the 2017 Tax Cut and Jobs Act. Had OBBBA not passed, it would have reverted back and made our friend Martin all of a sudden subject to an estate tax if he was to pass away at the limits that we're talking about. But now what was made permanent is this higher level of an exemption. And actually that exemption is now up to 15 million for an individual and 30 million for a married couple. And that will be indexed going forward and will increase over time. So that's a big increase. It would have been something more like in the 5 million range, which would have put Martin at risk of having to pay that.
Now, Martin is in Washington, so there are still state taxes that he has to account for. But this $15 million threshold gives clients a lot of flexibility in terms of keeping their estate under that federal tax exemption. So it's definitely something to work with in terms of Cutler. Gifting strategies are a big part of that. If you are worried that you're going to exceed that $15 million number.
Yeah, and there are a number of ways, by the way, to protect certain assets from exposure to that. Erich just mentioned gifting. If you talk to your financial advisor, there are a number of other things that are a little bit more detailed, a little more complex, even some things that can be drafted inside of wills, things like credit shelter trusts, those types of vehicles. Just know that those are options that are available as well. And certainly when we get into those kind of details, a good thing to bring up with your advisor if that's something that's going to be affecting you.
Yeah, Brook, can you talk a little bit about the no tax on Social Security? How did that play out? That was a big talking point and debate in Congress. Did we get no tax on Social Security into the bill?
Yeah, not exactly, not directly, but indirectly, yes. And what they did is sort of a compromise to satisfy this commitment to no tax on tips was to create a bonus deduction for those over the age of 65. And this deduction phases out like many things do with higher income levels. But what it does, it allows you an extra $6,000 of deduction from your taxable income. Well, that in essence is going to have the impact of sort of wiping out the taxes that otherwise might have been applied to your Social Security. Which pot it comes from probably really doesn't matter to most people, but in the end of the day, you're getting roughly that, we'll call it that free Social Security amount.
Now, I've heard this referred to as a below the line deduction. What does that mean? What are they talking about when they're talking about this deduction, and how it might impact your Medicare IRMAA brackets?
Yeah, that's a great point. So if you're familiar with IRMAA brackets, these are the income thresholds by which you can be assessed additional dollars that you will have to pay for your Part B and Part D Medicare premiums. And so as you cross each IRMAA bracket, as your income levels rise, you get a higher and higher premium for those two benefits. Now, one of the things, because your effective income will be higher, your taxable income will be higher with this bonus, they did put in a provision so that this will not impact your IRMA brackets. So you may have a higher taxable income, but it's not going to be detrimental to you from an IRMA bracket perspective. I know I've got a lot of clients who are concerned about breaking into those higher IRMA levels.
Absolutely, yeah. And one other change that might impact our friend Martin here is to HSA accounts. And Cutler clients have heard us talk about the triple tax benefits of HSA health savings accounts, the non-taxable on the way in, the non-taxable growth, and then the non-taxable withdrawals. They are a great vehicle for saving for retirement. And some of the eligibility for those HSAs has been increased through OBBBA. Just bronze level and catastrophic plans are now eligible for HSA contributions as well.
Exactly.
All right, so our final example is a gentleman named Chevy. Chevy is 25. He works as a programmer. He lives in Beaverton, Oregon, and he makes $215,000 of income a year. And he has two questions for us. He wants to buy his first home, but eventually he wants to buy his dream car, which he says here is a convertible Ferrari. So how does OBBBA help our friend achieve those goals? What can he do from a planning perspective and really take advantage of some of these new tax benefits?
Yeah.
So let's start with mortgage interest.
Yeah.
And Brook, take us down what changes there are there.
Sure. So you may recall there's actually a limit. This came in with the 2017 Tax Cut and Jobs Act, that the deductible portion of interest was up to the indebtedness level of $750,000. And now that has been made permanent. And by the way, one of the things I want to make clear, and I know we've had lots of conversations about this internal, what does permanent mean? And it really you should, as we think about all of these provisions that have been made permanent, it really means it requires an act of Congress to change it. Does that mean they will or won't? Who knows?
As we all know, nothing is permanent, but it is until it's not.
Exactly.
Right?
So one of the things I always think about too is as we make decisions today, especially about buying a large home with a 30-year mortgage, there could be many years where certain things might be applicable, but if the laws do change, things will change, obviously, if a different administration wants to see a different tax provision put in place. But for now, these are permanent. What the extension was not only was it increased or was it extended to continue at that $750,000 indebtedness level, but it also includes like even mortgage insurance and makes that deductible as well. So that's become part of it as well. And I know that certainly as housing affordability gets more challenged and people are putting smaller down payments, the more mortgage insurance does come into play.
Yeah, so we've got some good news and bad news when it comes to Chevy's next goal.
Yes,
right? So he has a goal of buying a Ferrari. And the good news is that there's a deductibility of car loan interest. This is a great kind of stimulant for the American car manufacturing industry. You can deduct up to $10,000 a year of interest, which is a pretty big car loan. Mm-hmm. So $10,000, can be a fairly expensive car. The bad news, it has to be a U.S. Manufacturer, U.S. assembled car. And I don't believe Ferraris are, so Chevy might have to buy a Chevy. And maybe he can look at
the new Corvette.
Yes,
I think it's practically in those same price ranges, so who knows? Maybe that'll work.
Maybe he can get a Corvette instead. So then finally, the deductibility of home equity debt. You've already mentioned that. Is there anything else you'd want to add?
Yeah, so what we're really talking about here is the what we commonly refer to as HELOCs, home equity lines of credit. And you may have recalled, again, if we went pre-2017, you could take out a home equity line of credit and buy a car with it. It was still deductible. Post-2017, the deductibility was only allowed if that substantially improved your home, increased its the viability of the home. And so that is all going to be carried forward and, again, made permanent. And so that is the case. And the only thing that I guess to keep in mind is that you do have to keep proof of the things that you spend those dollars on to show that it went towards the house. If you make it deductible, that is something that's auditable, and you want to make sure you're in compliance with that if you do in fact tap those kind of loans.
Yep, absolutely. So we just want to say thank you for tuning in today. Hope you like the new format. Brook and I having a conversation here today. But one last thing I want to emphasize is we use a lot of tools here at Cutler, and some of those are tax planning software and financial planning software these tools have integrated all of the OBBBA provisions into their assumptions. So we're now operating under this new financial, window where we have these new tax laws and we're making these new assumptions into our tax planning. So please reach out if you have any questions about how this might impact you and how we could potentially take advantage of some of these opportunities.
All right. Thank you, Eric. I appreciate that. And then I also just emphasize those same things. There are a lot of planning opportunities, not all of which we covered today. So it is a good opportunity to reach out to your advisor and see what might be available to you, what might be helpful for you to take advantage of some of the new provisions that have been put forward.
Perfect. Thank you very much, everyone.
All right, thank you.